Hello and welcome to AI Market News by LM. Before we jump into today's deep dive, here is the mandatory disclaimer. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at our own discretion. Welcome, everyone. So today we're diving into something pretty interesting. The market seems, well, almost optimistic.
Yeah, it's quite a picture, isn't it?
It is. Equities are shrugging off some pretty major geopolitical risks, specifically this ramp up in U.S.-China trade tensions.
All because the Federal Reserve is sounding, well, very dovish.
Exactly. So our mission today is to kind of unpack that. How is this happening? We'll look at currencies, sectors, and the key data points on the calendar.
It really is a classic case, isn't it? Liquidity versus fundamental risk.
Seems like it.
The market's just prioritizing the central bank easing over these pretty significant headwinds. It suggests a huge amount of faith in the Fed right now.
Okay, so let's talk about that faith straight away. The prepared resources suggest Fed Chair Powell basically cemented the idea of a rate cut later this month.
Absolutely. That seems to be the main driver for this risk-on mood.
And it wasn't really about inflation this time, was it?
No, not at all. His focus was very much on the labor market. He kept mentioning weakness there.
Like the slow pace of hiring?
Exactly. Slow hiring, the risk of unemployment ticking up. It signals the Fed's more worried about growth stalling than, say, inflation running hot again.
Which opens the door for more cuts down the line, potentially.
Precisely. And then there was the other piece, beyond just rates.
Right, the quantitative tightening, the QT.
Yeah, Powell hinted the balance sheet runoff, the QT, might end in the coming months.
Which is sooner than people thought. Why is ending QT early such a big deal?
Well, it signals they're stopping the active withdrawal of liquidity from the system. I mean, rates are one lever, but QT actually shrinks the money supply. And you see the impact immediately in the bond market. The 10-year Treasury yield, it's pulled back to around 4.011%.
Reflecting those easing bets.
Totally. It shows the market believes the Fed is serious about this dovish path, moving away from tight policy faster than expected.
And market behavior backs this up.
Yeah.
We usually look at the VIX, the volatility index.
The fear gauge.
Yeah, the fear gauge. And it's trading near historic lows. So, not much fear out there right now. The market seems to trust the Fed's got things under control.
So if the bond market is happy, where's the equity money going?
Good question. Looking at the futures, it seems to be heading decisively towards, well, growth in tech.
Makes sense.
U.S. equity futures are showing broad gains.
Yeah.
S&P 500 futures up, what, about 0.59%?
Mm-hmm.
And the NASDAQ 100 is leading, up around 0.74%.
Mm-hmm.
So tech and growth are definitely back in favor.
And there's some solid reasoning behind that tech optimism, especially in semiconductors.
You mean ASML?
Yeah, ASML, the Dutch chip equipment giant. Their Q3 orders beat forecasts, quite impressively, actually.
Which points to real demand.
It does. It shows firm demand driven by these huge long-term investments going into AI infrastructure.
And the scale of that AI spending is just massive, isn't it? The input sources mention potential contracts like for OpenAI's infrastructure, possibly topping $1 trillion globally.
It's staggering, and ASML is crucial because they make the unique machines needed for the most advanced chips. So strong orders for them aren't just a good quarter.
It's like a signal.
Exactly. It's a barometer for how real that commitment to future AI infrastructure is. It kind of underpins those high-tech valuations we're seeing.
But it wasn't only tech lifting spirits globally, right? There was news out of France.
That's right, yeah. French stocks rallied, and it was largely thanks to the luxury sector, LVMH.
Ah, LVMH. What did they report?
A surprising return to growth in Q3 sales. Their shares jumped, and it pulled competitors like Hermes and Kering up too.
But wait, didn't the IMF just warn about dimmer global growth?
Yeah.
How does luxury suddenly bounce back like that? Is it sustainable?
Well, that's the key question, isn't it? It could be temporary, maybe clearing inventory or some pent-up demand.
Right.
But the LVMH report did specifically mention resilience in consumer appetite, including in mainland China. It suggests maybe luxury buyers are a bit less sensitive to the broader economic wobbles than feared.
So a targeted sign of strength, maybe not a broad recovery signal.
I think that's a fair way to put it.
Okay, speaking of things to maybe worry about, the banks, strong earnings overall, right?
Yeah.
JP Morgan, Citi, Goldman beat expectations.
They did, yeah. Boosted by deal-making, trading activity. But there was a big but.
Jamie Dimon's comments.
Exactly. JP Morgan CEO Jamie Dimon, He gave a pretty stark warning about potential cracks emerging in credit quality.
I remember reading that. He used that analogy.
The cockroach analogy. When we see one cockroach, there are probably more. He mentioned a specific loss tied to a collapsed auto dealer, Tricolor.
Wow. That's not subtle.
Not at all. And it suggests the good headline numbers might be masking some underlying decay. He's not worried about the giant banks themselves, but about the health of the consumer, riskier areas like private credit, auto loans.
The places where stress shows up first.
Precisely. So the market can ignore geopolitics for a while, maybe. But if the credit consumer starts to break, that Fed easing narrative might not be enough.
Okay, let's pivot to currencies then. This should reflect the easing bets pretty directly, the US dollar weakening.
Yep, the dollar index is lower, down about 0.24%. It fits the picture.
And that means strength elsewhere, like the euro.
Exactly. Your USD is trading higher, around 1.1631. The currency market is clearly pricing in those likely Fed cuts, making the dollar less attractive from a yield perspective.
How about in Asia? The yen.
The yen strengthened. USD/JPY is down around 151.35. That seems like a mix of things.
Like,
Some safe haven buying because of the US-China tensions we mentioned earlier.
right.
And also more focus on Japanese domestic politics. There's stuff going on with the ruling LDP and opposition parties.
Interesting. And there was also something about India.
Oh yeah, definitely worth watching. The Reserve Bank of India, the RBI, is intervening pretty aggressively.
To support the rupee.
Yes. The rupee got close to 89 per dollar, and the RBI is calling it a speculative attack. They're actively trying to stabilize it both onshore and offshore.
What's their reasoning? Why so aggressive?
Well, it's fascinating. They argue the witness is all external pressure, not because of India's economy. They're pointing to strong fundamentals, inflation below 2%, GDP growth expected over 6.5%.
And they have the firepower to back it up.
They certainly do. They keep citing their huge foreign currency reserves, around $700 billion, fourth largest in the world. It's a massive buffer. They're basically telling speculators, don't bet against us.
So it's a calculated defense based on real economic strength, not just panic.
That seems to be the message, yes.
Okay, now let's tackle the elephant in the room. The one the market seems keen to ignore right now. US-China trade. Things have really heated up there.
They really have. President Trump threatening to halt trade in cooking oil.
Retaliation for China not buying US soybeans.
Classic trade brinkmanship. But China's response is significant. They're hitting back using their own leverage point. Critical minerals.
The rare earths.
Exactly. They added 5 new rare earth elements to their export control list. It's a clear move to control the supply chain for materials vital to, well, almost everything high-tech and green tech.
I saw Treasury Secretary Bessent called it pointing a bazooka at the supply chain, basically saying China is using its mineral dominance like the US uses financial dominance.
It's a power play, no doubt. China wants to be the governor of the rare earth order, not just a supplier.
And the world is reacting.
Oh, yeah. Australian rare earth miners saw their shares jump. It's forcing countries in Europe, India, everywhere to scramble for alternative supplies. It really puts a choke point on things like high-performance magnets.
And companies are caught in the middle. Look at Apple. Tim Cook was in Beijing, pledging more investment.
Right. But at the same time,
Apple's also expanding production in Vietnam for smart home devices, hedging their bets.
absolutely, diversifying away from China risk, especially with the U.S. administration threatening tariffs, if iPhone production doesn't move back.
It just highlights this bigger question, doesn't it? When trade and supply chains become weapons, what happens to global stability long term?
And the IMF outlook reflects that concern. They warned global growth prospects are dimmer, and they directly blame supply chain disruptions from tariffs and protectionism. It's a structural risk, even if the market ignores it today because of the Fed.
Which brings us neatly to the economic calendar. What should we be watching today, U.S. time? We usually check investing.com for this.
Right, so this morning, 8:30 a.m. Eastern Time, we get the New York Empire State Manufacturing Index.
What's the expectation there?
Forecast is for Negamorno 1.8. That would actually be an improvement from Menumo 1.7 last time, so we're looking for signs of manufacturing stabilizing.
Okay, and later today.
This afternoon, 2:00 p.m. Eastern, is the Fed's Beige Book.
Always important. The anecdotal evidence.
Exactly. It gives that district-by-district flavor of economic conditions. We'll be scanning it for confirmation of Powell's worries about the labor market.
And speeches. Any Fed officials talking?
Yes, several FOMC members are scheduled throughout the day. Bostic, Waller, Schmid. The market will be listening very closely for any deviation from that main dovish message or hints about rate cut timing.
Okay, so wrapping this up, the big picture seems clear, for now at least. We have these serious underlying risks, trade wars escalating, those credit warnings from banking leaders flashing yellow, maybe even red.
Definitely things to keep an eye on.
But the market's immediate focus, it's just lasered in on the Fed and its promise of easier money.
That dovish stance is keeping the risk trade alive, keeping things afloat. For now.
Thanks for watching. Don't forget to like and subscribe.